Good morning, everyone, and welcome to the European crossover webinar. And we did have some data come out. European market manufacturing final PMI coming at 57.9, just a hair better than what was expected. They did have German manufacturing PMI, which came in, same thing, a hair better. French, same thing, as well as Spanish. All of them came up just a tad bit better. Euro dollar is down 20 at 20.53. We do have UK data at the bottom of the hour. And at the top of this next hour, we do have Italian CPI. At 8 a.m. Eastern, we will have German CPI. That's at those states, was it, I always forget the name of it, the Handelsbrug, and it's not just Germany. I think it's those individual states. Hang on one moment. Oh, they already said Hesse came in. German state of Hesse came in. Coming into the States, we will have market manufacturing PMI final reading at 9:45 Eastern, along with construction spending at 10 a.m. and ISM manufacturing PMI at 10 a.m. Eastern. That will definitely move the market some. Moving on, we did have rates improve. We did have bonds. I mean, they really got whacked on Thursday with that auction. This is that spike that we saw with that when it spiked way up here. But as I was mentioning in the chat, I saw I think it was 6 dealers that came in and gobbled that stuff up. So it doesn't surprise me we're doing better. And you can see here right from the get-go in Europe, in Asian trading, we opened up and we started moving higher. We came up here into this 33.17, and if you look on a profile, there is a I can pull it up real quick. Hold on. I did share that in the room and on Twitter. You can see right here. Actually, that's ZB. Hold on. There we go. So you can see here, right here at 33.18. You can see here the upper portion of this value area, and then the lower portion for the previous day, 33.23.5. So that basically came up right to this area right here, and we pulled back just a little bit, but we're still holding up relatively well. Here, a moment. S&Ps 38.53, up 43, so really doing well. I don't pay that much attention to the S&Ps. I mean, I've got my hands full with the Nasdaq and focus in on the profile, and that seems to help me a whole lot better than just trying to cover all the entire thing of FANG. And as I mentioned before, one of the reasons I still have information on that, but I don't follow as closely is because over the course of the prior 2 months, FANG was, for the most part, was basically flat, while the Nasdaq just kept going higher and higher and all-time highs. And I was like, enough of this stuff. So, but like I said, I try and keep at least a little bit of a tune here on the S&Ps. It can still push up a little bit higher. I haven't done any real work on it whatsoever, but the profile seems to work very well for my style of trading. We can take a look at the Nasdaq here. And we'll go into that. We'll take a look, as I mentioned, just a quick overview of where the Euro dollar is. Bear with me. Let me just adjust this to the yellow one. Okay, great. So Euro dollar right there. We're pulling back a bit here. We actually came into that key level, that 2073, which is where the market closed, and then we're dipping back a little bit. We'll cover a story there. There's some concerns about the euro and where interest rates are and so forth. We'll take a look at the dollar index. Not anything big out of the dollar index. I mean, some people are looking for bigger moves. I mean, look, all it's doing is peering its head out of the basement. I mean, can you imagine how much the indexes have fallen? How much rates have skyrocketed? And this is not anything short of a skyrocket here. And look, all we've done is come out of the basement. Period. Its head above the basement. I mean, this thing should be trading at 92.68 easily. So it just shows you it's still inherently weak. Gold has rebounded. We'd come up to that. We actually rallied up here to 1757. We've got that key weekly level between 1753 and 1764. We did rally up there. I saw it just a little while ago when it was at 1757. I guess that was right at the high, and then we've kind of dipped back. But we have that key weekly level from between 1753 to 1764. And I was thinking, wow, it's a little bit stretched here. So we've pared back just a little bit to 1747, but obviously a beneficiary of what we've seen here in interest rates. So if you haven't been paying attention to interest rates, then you're way behind the curve. Straight up, that's it, because that's what's driving the bus and has been driving the bus in indices and several of these other markets over the last few days. So if you're not paying attention with what interest rates in the U.S. are doing, you're just way behind the curve. Bear with me. And henceforth, like I said, we saw this solid rebound from the get-go out of Asia, and that turned everything around here, and why we firmed up very, very well in indices. We'll take a quick look at those. So here's where we were Friday afternoon before, everything started going, everything just fell apart real fast. I thought we were going to push possibly up into this area right here, and we came up just a little bit short, and then we fell apart. Well, guess what? They've turned around and rebounded to come right to that area. This is right at 38%. We're actually pulling back. Now we're starting to ease back just a little bit. We'll see now whether or not this holds up. If they do push up in the U.S. session, I think somewhere in here is where they would potentially run out of gas a little bit, but there's different reasons why we can potentially push up. I think they caught a lot of people a little bit flat-footed. I thought that this is where they potentially could have gone to on Friday, and they just basically came up short. We rallied back, and then we faded them, and I think they caught some people underwater and probably squeezed some people. Wasn't sure. We were still holding up just a few moments ago at this 38%. Wasn't sure if they kind of hold their own in all the ways we go into the U.S. session, and then maybe make a stab up in this area here before paring back. But we'll find out whether or not we do or we don't. With that, we'll just take a look at a couple of news stories. I did post this in the chat room, but obviously, like I said, this makes a big deal as to what's been happening. Central banks will happily ignore inflation mongers. The world's biggest central banks will happily live with higher inflation and investors now aggressively betting on a quicker end to the monetary stimulus are all but certain to be proved wrong. After a decade of underestimated inflation, central bankers in the U.S., Europe, and Japan have reason to keep money taps open, and policymakers are even rewriting their own notes or rules so they can let the price growth overshoot their targets. If anything, central banks are more likely to nudge up stimulus, particularly in the Eurozone, keeping borrowing costs depressed and ignoring the inflation hawks, at least until growth is back to pre-pandemic levels and not just fleetingly. The RBA launched a surprise bond buying operation, which we covered that on Friday morning because, Australian bonds did get whacked on Thursday, or I guess it'd be Thursday morning might have been. Anyway, while European central banks have repeatedly warned investors not to push yields too high unless they want to fight its $1 trillion euro war chest. The argument behind the inflation warning is that once economies reopen, massive government stimulus will combine with pent-up consumer demand, unleashing spending, fuel pricing pressures unseen for decades. Although top economists are weighing in on both sides of the debate, the voices that really count all seem to be downplaying the threat. Inflation dynamics do change over time, but they don't change on a dime, said Federal Reserve Chairman Powell. And like I said, as they said, the voices that are ones that count, people can squabble and do this and do that and jump up and down. But if these guys, whether it's Powell the central banker for Japan or Lagarde, unless they want to go on and uh, chime in the other direction. If they want to act like they can ignore it, and like they said, to essentially write their own rules, then there's not a whole lot you can do it, because they're saying, okay, fine, take us on, and good luck doing that. So once again, now the market's having to adjust to that. But even if inflation accelerates a big, if given that the big central banks are all undershooting their 2% goal, tightening policy too hastily is seen as a bigger evil than moving too slowly. First off, much of the inflation rise is temporary, driven by the rebound in oil, one-off stimulus measures, and the base effect of tanking prices a year ago. So that is not the sort of sustained inflation policymakers are looking for. Tighter policy could also choke off growth, a costly blunder with tens of millions still out of work, and the biggest peacetime economic crisis in a century. In the worst case, higher borrowing costs would even raise debt unsustainability concerns, particularly in heavily indebted Southern Europe and across emerging markets. And lastly, the Fed and European central banks both tightened policy too quickly the past decade, forcing them to into the type of credibility damaging reversal they are now keen to avoid. Remember when what's his name? Can't think of the old bulldog face from the ECB. He was the one that ended up raising too quickly and really threw the eurozone into a into a bit of a spiral at the time. But anyway, the message from the Fed has been uniform and emphatic. Its $120 billion monthly bond purchases will not change until the economy is more fully recovered, and may actually increase interest rates increase is even further into the future. The Bank of Japan and ECB are making similar noises. There'll be no reversal stimulus for a long time. I did hear over the wires, BOJ is basically saying, hey, we're not changing anything. We're just going to keep on going. That was about maybe an hour and a half ago. There's still a $10 million job hole in the U.S. economy. U.S. unemployment rate is kept artificially low by government subsidies, point to huge spare capacity. And the Fed is already putting greater emphasis on job creation, particularly for low-income families, and made explicit commitment last year to let inflation overshoot its target. While the ECB and Bank of Japan do not have employment mandates, policy framework reviews now underway could raise the emphasis on social considerations, particularly jobs. The ECB is already debating the merits of its letting inflation overshoot. Labor markets tend to lag and real activity by as much as 6 months, and we may not see a wave of mergers, bankruptcies, and layoffs, said Tamara Basic. While the rising yields could cause a ruckus in markets, the moves and the excessive and may simply be a reversal of excessively low yields. The 10-year yields, U.S. 10-year yields are up 56 basis points this year to roughly pre-pandemic record lows, with Japanese yields are just 14 basis points higher. 10-year German bonds yields are negative 25 basis points. We see a return of bond yields from ultra low levels as a consequence of rather than an obstacle to a strong economic rebound. So let me see. And Atlanta's Fed President Raphael Bostic argued that the increase in yields was of no concern and did not warrant any Fed response. So if they're going to ignore this, there's not a whole lot then that you can do. And so the market then tries to adapt to that. And that's why I wanted to cover that, because I think that's obviously what's moving the market this morning, because had we seen rates continue to push up, we would have seen quite the fall in stock indexes this morning into the opening of the U.S. session. And we've seen basically just the opposite. Risk currencies recovered from Friday's carnage as bonds regained composure. The Australian dollar and other risky currency rebounded against the U.S. dollar on Monday as a sell-off last week in global bonds on worries about eventual monetary policy tightening appear to have eased for now. The British pound drew additional support from bets of a faster vaccine recovery. The market is overpricing the chance of near-term rate hike, said Toru Sasaki. Eventually, it's a true thing. It's true that the economy continues to be strong and inflationary pressures is getting higher. The central bank should be normalizing the policy rate, but we think it's too early to do that. So kind of an overreaction at the moment. The Aussie jumped to 77.54. The RBA, which holds its policy meeting on Tuesday, and markets are widely expected to reinforce its forward guidance for 3 more years of near zero rates. The New Zealand dollar strengthened to 72.70, sterling at 39.72 as investors bet a swift vaccination program would help lift the British economy from a driven recession or coronavirus recession. Currency markets have taken their cue from the global bond market, where yields have surged last week in anticipation of a swift economic rebound and on bets that the global central bank will need to tighten policy much earlier than they had been forecasting. Equities and commodities also sold off as a debt rout unsettled investors and lifted demand. There always is that joke about the plunge protection team. Well, to me, I think you might even have the bond plunge protection team. And so once again, I know that those dealers scooped that stuff up big time on Thursday. So we're seeing that matriculate in the Asian session from this morning. And that's why I think that potentially we're holding here at that 38%. We're not coming off very much. So potentially, I think that we'll see how it plays out. I think there's different scenarios, but to me, I'm thinking we might even be able to come into this area right in here, but we'll see. I'm thinking if the market doesn't back down much, we could squeeze some people up into this area, and then this would be a fabulous area. For starters, maybe we can just at least come up in here, this 13,154. I think somewhere between, let's say, around here to the 170s is going to be key. And 13,202 would be the 78% back. So there's a lot of, an area. If we can jump up, I think we might. This might be where people say, I can't take it anymore. I got to have my stops, right? I'm thinking here. Could be wrong. I'm just playing it cool for now, but I'm thinking people like, if it gets beyond here, I've got my stops here. I got to get out. And potentially, I think that maybe we'll see whether or not that happens or not. Maybe we could come into this area. I think potentially, if we don't pull back enough, we could pop them up in here, and then maybe we tar out, and that might be just right here where these people get stopped out. The ones that are short from here on Friday, here on Sunday, and potentially they could get stopped out. We'll find out what happens, whether or not, but that's the lay of the land, at least the way I see it for now. We're going to move into the analysis. Didier says, can you please look at West Texas Intermediate? And Amira says, take a look at Platinum. Okay, so we will do both of them. Let's take a look at Platinum because Amira was the first one off the bat, and we'll look at West Texas. So hang on, let's start with Platinum real quick. Let's go into this daily. Understand when we look here on the weekly. So if you look on this weekly, well, we've been talking about this before. So this is right here, that key thing, 1242. They're holding up pretty well. They're above the previous week's close, okay? You'd be looking, what the key thing is going to be that 1240 area, 1242. That's going to be key. What you can also look at is, let's go to the daily and take a look at a fib. See, the 38% comes in at 1238. And remember, we've got that 1242 there. So that's going to be your key area right there between 1238 to 1242. But essentially, it's still going to be 1242. 1242 right there. Right there. Actually comes in right there. So I guess it's 1241. That's going to be the key. See all these touches down here? That'll be key. 1241 for now. And then taking a look at crude. let's do it just CL, because that way it'll allow the complete rollover. So hang on. There you go. And let's take a look at it on a weekly. Let's take a look on a monthly. So if you look at it on a monthly, there's huge resistance there at 63.43. That's on a monthly. And that's in 2019. 63.43 on a monthly. And we did get above it, and we kind of pulled back a little bit. 63.43 is huge. Once again, on a continuous monthly. Get it right there. 63.43 on a monthly. Let's take a look at it. And we can actually we'll do a fib also. We just went above that 78%. Actually, it closed just a hair right at the 78%. But that 63.43 is pretty huge. 63.44. Now that's with a monthly. We'll take a look how it stands with a weekly. $63.01 on the weekly. 63.01, but 63.44 is what's key on the monthly. 63.01 now. Let's go to the daily. You got this little hanging man. It's not even a hanging man because really the wick's not long enough. So let's go move into a 2 hour. Oh, you can see right here. This is the key level right there. 63.12. As long as we don't get above 60, so that's where your stops would be, immediate stops. You wouldn't want a 2 hour close above 63.12. So you can move this down right there. Essentially 63.12. You could even push it down to here, which is 62.97. But 63.12, you can see where all these wicks have jumped up. You see here. Here's a close here, just a hair above it. The wick touches it here. The wick gently goes beyond here. The close is right there. Open here. Wick below, wick below. So if you look across the board, the most uniform area right there is 63.12. Right there. So as long as you don't get a 2 hour close above 63.12, it's still in a buy mode on this using this one. But what I've always not found out, but this works pretty good, which is the 927. That's actually one that I actually developed when I used to trade crude way, way back when. And I would actually use it against, I think it was like a 40-minute chart. But if you looked at it on a 30-minute, which I like to use on 30-minute, we flip back into the buy mode on this 927. So if this closes down here, that would give us a good little sell signal because look, you've been on a sell mode. You see that? We get above it. If you roll back below it, then everybody that got here is going to be trapped. So keep an eye on that. On the 30-minute, using this 927. Once again, you can see here, we got the sell signal here. It stayed that way. You see how we got above it, never could close. You can see here, we finally got above right here. If we were to roll back, then that'd be huge because then the momentum would shift right back down. And you'd have all these people that stepped in and said, okay, I'll buy. I've got a buy signal here. They'd all be trapped. And then people that would say, well, I'm willing to sell if we get a break below here. So you'd end up pushing it right back down. So you don't want it to get above 63.12 on a 2 hour close. And right now, you got to keep an eye on this here. And that'll be it there. Let's go and move into FX. We are seeing Nasdaq pull back a little bit. I did get a scalp earlier. I just wanted to be patient. That 38% is holding, but the market was holding up relatively well all by itself. And I don't know, it was such a big move we saw on Friday. I don't think that move's going to be resolved, even though we went to the 38% in the European session. I'm just going to try and be patient and just wait. We'll see how that plays out. Let's just go on and move into the FX analysis. You can see here we are pulling back. So looking here on the euro. Oh, wow, we're still pulling back. Holy smokes. So the euro posted a solid day after the gravestone doji on Thursday. Support to start the week will be 2044 with resistance at 2118. Wow, and we're still dipping. And this is where I'm coming from, this 2044 right there. So we're still pressing here. But I'm going to go with that. I don't like to change it unless there's something hugely material. Of course, I do the analysis on Sunday morning before the markets even opened up. I'm just going with the levels there. And then on the upside would be 2118. And onto the cable. Cable saw 2 consecutive lower closes to end the week after a stellar run. Support to start the week will be 38.53. And we're still doing pretty good up here. With resistance at 40.13. Yeah, it's going to be pretty wide considering what we've seen already. So 38.53. And 40.13. On to Aussie. So the Aussie saw a solid drop to end the week from extreme overbought conditions. The pair has slid to the 50-day moving average. Let me move this back. There we go. The pair has a solid drop, saw a solid drop to end the week from extreme overbought conditions. The pair has slid to the 50-day moving average. You can see that. Support will be 76.75 with resistance at 78.11. But you can see how this 50-day moving average has really held this market. So it will be supportive, but in case it was a little bit further dip, like we've seen with the euro, but we're not seeing it so far, 76.75 resistance at 78.11. I would have liked to have sold that, sell it again, which would have been the Nasdaq going to at 38%. But we've seen such a massive run up in Asia. I wasn't sure, if, like I said, if they try and hold it its own and then try and push it up even further some more in New York. So I'm just going to try and play cautious and wait because we've had such a big move and treasuries have held up very well. Anyway, let's go on and move into the Kiwi. So the Kiwi paired back sharply into support level, 72.28. Support to start the week will be 71.77 with resistance at 73.16. And you can see here they're holding up very, very well. Things have calmed down, so we're not seeing this extra push like we're seeing in the euro. So let's go and pull this back up. So it's 71.77, 73.16. Onto the dollar CAD. The dollar CAD posted a solid rebound to close the week. You can see here it ran right into the 50-day moving average. Resistance comes in at 27.65. You can see that right there. 27.65 was supported 26.57. Next is the dollar peso. The dollar peso challenged the 21 level twice. You can see that right here at the end of the week. Support will be 2073 with resistance at 2107. On to the dollar yen. The dollar yen has posted a run over the month of February. The pair stalled at 661, which will be resistance to start the week with support of 591. Well, we're still pushing a little bit higher here. Things have, like I said, with the bonds kind of calming down, to kind of change things a little bit. I'll still stay with the 661 with support of 591. And on to the dollar index. The dollar index has done nothing more than peer its head out of the basement. Nothing more. This is despite a sudden ramp in U.S. interest rates and a pullback in equities. This index should easily be at 92.68 in light of the aforementioned backdrop. Resistance to start the week will be 91.20 with support at 90.59. And let's go into the cross rates. The Kiwi yen saw a pullback from its meteoric run. Support to start the week will be 76.08 with resistance at 77.93. And on to the euro pound. The euro pound posted a hammer on Wednesday, signaling a turnaround. Resistance will be 87.70 with support at 86.36. Well, we're right there right now. Few pips lower. 86.36. Well, there we are. And 87.70. On to the euro odd. The euro odd posted two solid positive moves to end the week. Resistance will be 57.86 with support at 55.62. We're right there right now. Looks like we just went to 55.62. So let's go here. Doggone it. Okay, Euro Kiwi. Okay, the Euro Kiwi rebounded to close the week. Resistance for the new week will be 68 cents even, with support at 66.10. So we've actually come already down here. We've taken on 66 and we're rebounding for that area. So 66.10. And 68. Onto the Aussie. And all these are just derived from just the technical levels. That's it. Like I said, I'm not trying to say, oh, well, this happened and that happened and all these different reasons. Let's go into the Aussie. The Aussie, after an epic run, has pulled back slightly. Support to start the week will be 81.71 with resistance at 83.12. And obviously there's wider ranges because we've had such a big run and then a pretty decent little pullback. So hence why the ranges appear to be somewhat wider than we normally would have them. 81.71, 83.12. On to the guppy. The guppy, after breaching 50 cents even, or basically 150, paired back to support level of 47.41. Resistance to start the week will be 48.95. Oh, wow, we've already taken a dip up there, and then we're pulling back a little bit, followed by 49.43. So it did appear its head above there. Support on a break will be 46.68. So 46.68. And resistance is 48.95. 49.43. And we can take a look at what the high was. High was 49.28, so not too far off. On to the sterling odd. Not really anything of any real consequence on this pair. Starting off close the week above 80.41, allowing for a further upside move. Resistance to start the week will be 80.89. Actually, we went there. We just tagged up to 81, even just a hair above it. 80.89 was supported 79.67. So here we go. And 80.41. Oh, wait a minute. No. 80.89. There we go. And there we go. There's the bias chart. We are seeing Nasdaq continue to pull back a little bit. We're 30.78. But as I said, I'd be a little bit cautious and wait till the U.S. Open because we've had such a and I'll get to that. So just want to share that in case anyone wants to take a quick screenshot, although I will post it in the room. Getting back here to the Nasdaq, as I was sharing, which is the bulk of my focus, I would be careful with this. Now, we've pulled back a little bit, but not that much. Now, we're at the 38%, and this is where I thought we were going to potentially go to on Friday. And we came up a little bit short, and then we ended up pairing back. But my concern is that, okay, we sold off hard on Friday. So a lot of people, and we saw a ton of volume in here. So you could have people that are like, uh-oh, well, hopefully it didn't get up in here. And then we sprung up here. Those same people may try and pick up any dips here. My concern is because of such a big move that we saw on Friday toward the end of the week, and then we've seen interest rates improve, is that we could end up pushing here and try and goose the stops. And so my thinking would be potentially, I don't know, because like I said, it's such a big move that we had, is that anybody who's short probably has their stops right in here. They're like, enough. If we get beyond 38%, I can't stay short, blah, blah, blah. And that's why potentially, don't know if it'll happen, we might end up moving into this area. And then I think we could stop. I would have thought that this would have been an excellent area on Friday. This was, I was had looking my chops, thinking we're going to come up to here, and then we pair back. We came up short, we came down here, we rebounded up to here, and then late in the day, I was still, although I wasn't really in front of the desk at that point, but I was thinking maybe they'll try and pop them up in here. But no, they broke them hard, and there was a ton of volume in this area. So there might be people that are stuck short, and so we may not really get any real resolution until we get into the U.S. session and they punch it. Maybe if they get above here, I think there'll be a bevy of stops here, or maybe not a bevy, but the people saying enough is enough. That's it. I'm out. And then we make it up in here, and then we run out of gas. But we'll see what happens. Anyway, that's it. Thanks for joining us here on the European Crossover webinar, and have a good day. We'll see you in the chat room. Oh, Didier says, can you please take a look at Bitcoin? We did. Okay, so let's take a look at Bitcoin. I thought that we would come down to 42. I know that Jane was looking for 44, and I'm looking for 42. So it's kind of split in the middle, so to speak. We're holding up better, but I think same thing. I think it's holding up better because the interest rates are holding up better, which is actually helping up indices. But my thought was we would come down to 42. We're still holding up here, but here, this is the key level right there. Remember, that's been the key level for a long time. That's at 48,135 here. So if we get I would say 2 consecutive closes above 48,135, then you're in good shape. But my concern is if things start to turn back around, I myself would put a lot more credence on what happens with indices. So if we come back here in indices and we hang around here, then you can still move higher. But I think you'd have to get actually even more so than a 2 consecutive 2-hour close above 48.31. 48.131 actually comes in at 48.181. 48.1. I'd want to see a daily close. If you can get a daily close above there, then you're probably out of the woods. But I would be hesitant. If you picked it up down here, I would actually be taking at least a portion of your position off on a move up to this area here. So I hope that answers that. And thanks for joining us here in the European Crossover webinar.